Tere Tallinn. Thank you for having me. Thank you, Andrus, for inviting me out here. This is my first trip to Estonia. And Andrus had asked me to talk about the power of angels and the revolution of angels, which is really a story about the evolution of a small and mighty force. And based on my time here, I have a sneaking suspicion that everybody in the crowd is actually very much an expert on this topic because of my experience with Estonia as a small and mighty force itself, both in terms of the history, and then also last night at dinner, several things became apparent. The first of which is that Estonia is a small country, but it's punching above its weight. I was with Alar, we were talking about how there's no debt, and the Estonians are bailing out the Greeks, and there's innovations here that haven't existed in places that are much bigger, like electronic voting. That was the first thing. But then we were also talking about the women of Estonia as punching above their weight as well. And then finally, at the end of the evening, I had a little tiny, a very small, but mighty bit of Vanna Tallinn, which was a small and little innocuous glass that just absolutely knocked me out. And so I think you guys know about the power of the small and mighty, and I am going to expect you guys to participate in this discussion as we look at a small and mighty force that's happening in the venture capital world, which is the emergence of the seed or the angel. Now, before I begin, we have plenty of time, actually. We have 30 minutes, and there's a whole bunch of things that I can talk about. But the really fun thing about coming to this event live is that there can be two-way input. So I wanted to see what was on your minds, if there's anything specific that you guys wanted me to address. And I'll go over my background again, but briefly, I teach at Stanford, so I teach entrepreneurship at Stanford. I've worked in venture capital for 6 years, and now I'm running an accelerator. Are there any questions that are burners on people's minds that they want to hear addressed? This is like true entrepreneurship because you have to take a risk to get a reward. Yeah.
Wait. Excuse me. Can you say again? Yes. With the mic. Sorry.
Thank you. If you can point out some specifics in business administration or teaching in Stanford compared to what you know is going on elsewhere.
Fantastic. So specifics on Stanford's approach to education versus others. Okay. What else? Yeah. Down here.
Toby Moore. I'm interested in this cultural difference. So your first time to Estonia, but you've spoken with some people and perhaps got some sense of how things are here. Cultural difference from here to California generally, and Silicon Valley in particular, because it seems a big difference.
Yeah, so that's great. So cultural differences between
because
Silicon Valley
it's
and
a challenge then for companies, small companies here from small countries to go there physically and then emotionally, socially to integrate into that culture because the culture is so different.
Okay, fantastic. What else? Yeah, we got one in the back, and then we'll do one there, and then.
Hi, I'm Harry. I remember from Bill Payne when he was here that he's also acting as an angel, and he said that he sees the problem that VCs are less and less active now, and there's less possibilities for angels for exit. Do you share the view?
So the issue of how do angels exit if VCs aren't coming in? Yeah, okay, great. And we'll do one more back there.
Hi, Tarodam. Couple of things. One is sort of follow-up to this, focus on the early exits when it comes to angels. And another one is if you have experience of sort of to elaborate the different mindsets of angels in US and in Europe.
Okay,
Thanks.
So it's again, this is sort of going back to the cultural differences, but more on the angels side of those differences between the US and Europe. Okay, great. those are all great questions, and I'm going to try to weave in, especially more of the European, US differences as we get through the presentation. But I'm going to first try to build up to the situation that's emerged for why the angels exist today. Okay? And we have 30 minutes, and so we'll see how much we get through. Okay? So this is the first time I'm giving this presentation. And again, it was because of the Van Dalen last night that I did it this morning. So my quick background is I was at Draper Fisher Jurvetson for 6 years. The Jurvetson in Draper Fisher Jurvetson is a half Estonian, Steve Jurvetson. And through DFJ, we funded, and when I was there, we funded Skype, as well as several other fantastic companies that have changed the world in different ways. Before that, I worked at McKinsey, and I worked at 2 Kleiner-backed startups. One went public, and the other wasn't a success, but it was a fun ride. And now I teach at Stanford. I teach the entrepreneurship curriculum, the entrepreneurship survey class at Stanford called the Spirit of Entrepreneurship. And I run an accelerator called the Alchemist Accelerator. And we're taking applications now. So the accelerator is backed by Draper Fisher Jurvetson, Khosla Ventures, and US Venture Partners. And we're starting a class in the beginning of July. So applications are welcome if you go to alchemistaccelerator.com. And then we also have a free site called Founders Hookup, which is if anybody's looking for a co-founder, it's a free directory of co-founders. So those are a few plugs, a few presents of what I'm doing presently right now, and a few presents to you guys. On the Stanford site, if you're looking for what we teach at Stanford, there's a website called etl.stanford.edu where all of our videos are posted. So you can check out all the luminaries that come in. We had Daniel Ek from Spotify come in recently as well, and you can see the real-time, the lectures that are happening there. Okay? So now I'm going to take a little step back and talk about about what's happening in venture capital and why there's the emergence of angels. So in some senses, what's happening right now, what you're seeing with the emergence of seed stage venture capital is really nothing new. Because historically, there's always been a vacuum where there's been a spot for a seed investor to come in to fill whenever a successful seed investor raises a big fund and has success and then goes on to the next level. So in some senses, nothing's really new. And I'm going to give you a really early case study of Kleiner Perkins. How many people have heard of Kleiner Perkins? By the way, how many people in the audience are VCs? Okay, and how many people are founders? How many people are angels? Angel investors? Okay, good. That'll help me calibrate what I'm going to say. So Kleiner Perkins started out as an angel fund. Okay, their first fund in 1972 was $7.5 million. They made 17 investments, and their average check size was $450,000. It's almost like they were an angel fund today that was just starting up. And they provided these services, all those services that we typically think of an angel fund or a VC fund. And that $7.5 million fund returned $345 million. Okay? So it was a 46x return. Not bad. Now, if you looked at that portfolio, they made 17 investments in that portfolio. 2 were responsible for 90% of their returns. So if you took out those 2, the returns would have been 10% of what you actually saw. Okay? And this is going to become the overarching theme of these notions of how big the returns in venture capital are driven by just a couple investments. So when you have a 46x return, you're fortunate enough to get capital. So suddenly, people throw capital at you, more money. Okay? And so in 1972, Kleiner Perkins had $7.5 million. Today, they have $1.4 billion. Okay? And the question becomes, how do you scale? How do you scale venture capital? Do you scale venture capital by doing the same size checks, those $500,000 checks, but do a lot of them, so you change the number? Or do you do the same number of investments, so the same number of portfolio companies, but increase the check size? Okay? I'm going to run through it just because I know I'm going to run out of time, so I would have made this more interactive. But the reality is that what happens in venture capital is option B has been the predominant standard. Venture capital has notoriously had difficulties with scaling in terms of just scaling the same business model. And instead, the constraint has become the time of the individual partner. So what's become clear is that it's not the money, it's the fact that the individual partner can only make 17 investments. Or in that fund, it was 2 partners, Kleiner and Perkins. They each did sort of 9 investments, and they can only do 9. And so what happens is that when you get flooded with all that money, you still can only make those 9 investments. And so the degree of freedom that moves is the check size goes up, okay? And you can see this historically. So these are Vinod Khosla, who's one of the top venture funds, capitalists in the Bay Area. This is individual portfolio return, okay? So if you look at Vinod Khosla and what he invested in, those are all of his investments. His average return when he invested less than $1 million was 200x. When he invests more than $1 million, it's 4.5x. And when he's on the board of a company, his success rate is, his average return is 70x. And when he's not on the board of a company, it's 8x, which is not bad. This is Vinod Khosla. But still, the key takeaways are that attention matters. So VCs have typically believed that they need to be on the boards of the companies and they need to drive things. And so when you get flooded with all this capital and everybody wants to invest, the bottleneck, the degree of freedom that typically moves is the check size goes up. And you can even see this further if you look at the top 10 performing funds of all time. Venture capital has had an awful time scaling. The top 10 funds of all time, if you look at their sizes, there's no fund that's greater than $252 million. So they're all between 150 and 250. And so the opportunity then is that when you have success and you start writing bigger check sizes because you're limited by your time, there's always a role for somebody else to step in and start writing the smaller check. And so that's always been the beautiful opportunity that venture capital has given to the next generation of venture capitalists, is that you can always compete, and this is sort of like me, by writing the smaller check that the VCs don't have the time to write. So in some senses, nothing's really changed, okay? So what's different? And what we're going to get to is Archimedes has this principle that if you give somebody a long enough lever, they can move the world. And now we're seeing people with really long levers moving the world with very little force, so very little cash, and you're suddenly making these billion-dollar game-changing companies like Spotify. Why? What happened? So the big fundamental difference of what's happening today is that human experience and technology development are diverging in a way that's becoming apparent to humans. And this will hopefully become more clear. Okay, so my thesis is that really what's happening is that there's this divide that forms between fund economics and Moore's law, what's happening in the technology landscape, and that chasm is just going to get worse. So funds are raised at a fixed period of time, and what happens when you raise funds is that human beings extrapolate from the past. They look at your historical track record, or they look at the present. They're looking at some trends that are occurring right now, and then they project into the future. Okay, and they say, okay, based on your past track record and based on what I think is going to happen, I'm going to give you money, and this money is going to last for 10 years. The funds are 10-year funds. So you basically freeze time for 10 years, and you have a vintage. When you raise a fund, they're called vintages, like a bottle of wine, and you get enough money for 10 years based on a thesis that's made at the present moment, and a thesis that's largely a function of what's happened in the past, your track record. The problem is that technology develops faster than we're built to anticipate, and that the future is actually wildly misunderstood, and as human beings, we're not designed to actually anticipate what's going to happen in the future. This is the innovation curve, which is classically Moore's law. So Moore's law talks about the density of transistors on an integrated circuit, but more generally, what Moore's law is talking about is the amount of calculations that we can do per second for $1,000. So if you look at the latest technology paradigm, whether you go all the way back to mechanical switches or vacuum tubes to today, technology has developed at a very predictable pace. But the thing that's the hitch here is that everything on the y-axis is an exponential curve. Okay? So if you're doubling every 18 months, that means that everything that we've done in terms of developing Moore's law in the history of humanity will be replicated in the next year and a half. So every 5 years, you're going up a 10x of computation power. Every 10 years, you're going 1,000x up on, or 100x up on computation power. So it's a 10 squared improvement, okay? And our minds aren't wired to think like that. When we extrapolate in the future, we inherently extrapolate from what's happening today. And you can see this across every technology trend that has that dynamic at play. This is data storage. It's also growing exponentially. That's an exponential curve. This is the growth of the internet. Now, it's probably hard to appreciate this because I'm showing it to you in the terms of the way technology grows itself, which is technology grows exponentially based on a multiple that's applied every year. The next slide, I'm going to show you what it feels like to us, which is the next slide is going to be linear. So this is the exponential curve, which seems pretty flat and reasonable. That's what it looks like linearly. So to technology, nothing's really changed. But to the human experience, which is linearly, it felt like the world went crazy in the late 90s. But really, technology was still growing just at the same geometric curve. It was still growing at a multiple every year. But to our eyes, it felt like things were completely changing. And that's really what's happening today with the angel market, is that what's today, 10 years versus 10 years ago, things are 100 times cheaper. So what used to cost $5 million 10 years ago to do, now you can do it for $50,000. And that's really because of nothing more than Moore's Law at the end of the day. And the way that manifests itself into our world is that we see it in terms of, people talk about these. These are the long levers. So, 10 years ago, it felt like you had really short levers, and to rule the world, you needed a lot of force, a lot of money, because you needed to get proprietary database licenses. You had to spend $250,000 for a database license. You had to set up a server. You had to spend on marketing and so forth. And today, our long levers are things that have really benefited from Moore's Law that don't require a lot of cash. They're open source stacks. It's infrastructure as a hosting service, Amazon. You can use Facebook and Instagram and Pinterest for customer acquisition, or Foursquare. And you have mobile app stores, which are now your business development, effectively. So it feels like everything's actually radically changed, and the cost of capital has gone down. But really, it's actually a predictable thing that what happened from the technology landscape of Moore's Law. At the same time, what's happening is that the revenue ramps are steepening. And Martin was speaking to this about how you're having these billion-dollar companies emerge quicker than has ever happened in the past. And if you look at the revenue ramps of what's happening today versus what happened 10 years ago, or the valuation ramps, they're 4 times steeper than what they were for the winners. And this is just unfathomable. So if you looked at Zynga or Groupon, like Groupon went to, I think it was $650 million of revenue by year 2. You can question that revenue, but $650 million of revenue by the end of your second year. And Zynga hit around $750 by the end of their third year. Of revenue, $750 million, absolutely unbelievable. The problem is that the VC funds were set up 10 years ago, or whatever. They were set up when they were frozen at a point in time with a 10-year horizon. And so the VC funds, by humans, were sort of projecting linearly and set up with a certain allocation, but they can't dynamically adapt to the change that's happening technologically. And so there's this dilemma. So the dilemma for the VC funds is that you're seeing all these companies that don't need as much cash. They need $50,000 where they used to need $5 million to do what they did before. And they're growing quicker. So the winners are exploding and changing the world quicker. The dilemma for the VC is that if they do invest, they have the money. And if they do write those $50,000 checks, or $250,000 checks, or $500,000 checks, they don't have the time, okay? So the entrepreneur will feel disenfranchised because they really don't have the time to dedicate to the entrepreneur. And I don't fault the VC. The VC is not acting wrong. The VC has to focus their time on where they're spending the most money or where they have the most ownership, which is typically when they're writing the $5 million checks. So they can try to do the seed investing, but they're going to have to sacrifice on their time. They don't have the time to support those companies. Or they can spend the time, but then they have to do very, very few investments, and so they miss out. So that's the dilemma. And the founder's dilemma with VCs, the founders in turn, there's a dilemma with the venture capitalists, which is the incentives. And when I say these dilemmas, nothing's bad or good. There's actually really no value judgment. It's just differences. So the first difference is economic alignment. Do you guys know how VCs make money? Should I walk through this? So you should know this, actually, and I'm going to go through it pretty quickly. But venture capitalists make money 2 ways, typically, off of a management fee and off of carry. The management fee is a percentage of the total size of the fund. So typically, that's 2%. The best funds, it's 3.5%, but we'll just say 2% here. And then you get a carry, which is a percentage of the profits that you return back to your investors. And that's also 20 to 35%, but we'll say 20% here. Now, what's interesting is that the fund, even though it has a 10-year life, it's committed typically after 3 or 4 years, What that means is that if you come and you raise money for me, and I'm a venture capital fund and I have $500 million, I'll give you $2 million, but I'll reserve $5 million on my books for your next rounds of financing, okay? So I've committed $7 million on my books, even though I've only given you $2 million. So even though I have a 10-year life, by the end of my 3rd year, I've already committed the $500 million for the fund. Does that make sense? And so, at any one point in time, there's actually 3 concurrent funds that I'm drawing down management fee on. There's the current fund that I'm actively acting out of, and then there's 2 funds historically that still are in that 10-year life period. So here's the so this is where the incentive misalignment comes in. And it only comes in, and it's sort of a natural healthy misalignment, if you're trying to go for an exit that's not aligned with the VC. So if you're exiting, let's say you're starting a company and you don't need any cash, and you have an offer for a $20 million acquisition. If you're a VC partner, because of the economics spelled out before, and there's a lot of assumptions built in here, but you're taking home, if you're at a $500 million fund that has had 3 $500 million active funds, and there's certain assumptions about the distributions, you may be taking home $3 million a year of guaranteed salary just off of the management fee, okay? And a $20 million exit, if you do the math, if a VC fund gets 25% of that exit, which is $4 million, and they have a 20% carry, and one VC is one of 5 partners, that individual VC who's on your board is going to take home $160,000. So relative to his cost, relative to the money that he's taking home every year, which is $3 million, that $160,000 is just a 5% dent. It really doesn't change his life. And I'm talking purely as the individual motivation. For a founder, you're probably making $150,000, and a $20 million acquisition would have a huge change on your life. It would be a $5 million exit, and that's a 30x change for you. The difficulty becomes that your economic incentives are different, but your decision-making is the same. So you're both on the board of a company. And the reality is that the VC has to do, to a large extent, what the founders want to do. But there's a misalignment when it comes to the small exits. For an angel VC, we won't run through the math, but because of the way the economics work, an exit of $20 million is much more meaningful. It pays back more of their fund, and it's the angel VC is probably getting less of a salary, and so it's a 2.5x change for the angel VC. It's still a 30x change for you, but it's drastically different in terms of aligning your incentives. That is intentional, because for a big fund, a $20 million exit is not worth their time, and they don't want you to be incented for that exit. But if your goal is to have a $20 million exit, your incentives need to be aligned, and so there's an economic misalignment if you're taking money from a big fund. The other issue is there's a signaling problem for venture capitalists, where if they invest in you at the seed level, and they also commonly write Series A checks, when you raise your Series A, oftentimes people will ask, why aren't they leading the round? So as an entrepreneur, you sort of have golden handcuffs because you're indebted to them and you give up that optionality if you take in the money early. So that's been the dilemma. And that's why seed funds and accelerators have emerged. And it's a one way to resolve these problems. So, if you see Y Combinator, I don't know if people realize this, but Sequoia underwrites the majority of the money that Y Combinator gives its entrepreneurs. And when people think about Y Combinator, they don't really think about Sequoia. They think about it as Y Combinator. So if Sequoia doesn't invest, it's not a ding on you, because it's viewed as just a Y Combinator decision. But Sequoia can come in and cherry pick the companies that it wants. Similarly, I'm doing an accelerator, and Coastal Ventures and DFJ are backing in. Part of the reason why is that there's a natural synergy there for that same reason. So it's a fantastic time to be an entrepreneur, because there's all these accelerators emerging, and there's so many sources of capital for that initial $50,000 to $150,000, okay? And these are a couple: AngelList, Kickstarter, Wise Guys. There's so many fantastic ones that are out there. Okay, so here's some quick advice then if you're an angel investor, and we have a couple in the back. There's the old Anna Karenina quote from Tolstoy that happy families are all alike, and but each unhappy family is unhappy in its own way. The same holds true for standout investments. So I call these unicorn investments. So the good thing about being an angel investor is that you are in the pole position to take the first look at companies, because some VCs won't have the time. And there will be companies that will only raise that first round of capital. And all these companies on the right, eBay, Google, Hotmail, there's a bunch of others, only raised one round. So, and I call these unicorns because they're rare. Everybody likes to talk about them, but they're really rare. But you have the ability to get those. Now, my advice is that if you're really going to try to go for those companies, just because the markets are capital efficient does not mean that the companies are going to take off. This is a correlation causation problem. It's sort of like I was awake at 4 a.m. this morning in Tallinn, and it was bright outside. It was really, really sunny, but I wasn't awake. So just because it was sunny outside doesn't necessarily mean that, and I know this is sort of obvious, but you can have sunlight 24 hours a day, but you're not going to be awake 24 hours a day. You need to be internally motivated to be awake. It's not that different with investments. You can have companies that need very, very little cash, but if you're going to want companies that are going to change the world, you need to focus on the business model, not on the costs. The costs are being driven down because of Moore's law. But just because the costs are low does not mean that the companies take off. The companies are going to take off because of the revenue drivers and their business models. And if you don't pay attention to that, it still takes a ton of cash to build companies over the long haul, unless you can fund one of these companies. And you have to look at companies that have very common business model traits: viral adoption, strong network effects, they ride a technology disruption, and the market timing is perfect. Okay? So my advice if you're an angel investor is to be very vigilant about those. Okay, if you're not hunting unicorns, and if you're not going for $20 million exits, and you fund things that don't have those drivers, you still need a lot of cash. Okay, and cash is still very critical. And I'll give you two quick examples. One is WebEx and Salesforce. Okay, these are classic examples that on paper would seem like they would be perfect companies to take off. WebEx is a simple product. It's capital efficient. You sell it using the product itself, which is you use WebEx to sell WebEx. And you would think it would be one of these companies that would be perfect for a seed investor. And Salesforce is similar. Salesforce is a very sales-centric type of company. If you look at the economics, WebEx took $100 million to get to operating income positive, and 34% of their revenue is spent on sales 8 years after founding. Okay? So this isn't just in year 1 or year 2. 8 years later, after they got started, they were still spending 34% of their revenue on sales. And so especially, I don't know if you can see this, but if you look at from 1999 to 2000, revenue went from 2 million to 25 million. Fantastic. Cash spend went from 14 million to 82 million. Okay, so in the year when they grew 10x in revenue, they consumed more cash than they've ever consumed. Salesforce, what percent of revenue do you think Salesforce is spending on sales today? Salesforce is not a startup. They are past their growth curve. They're a mature company. They're a public company. And they still spend 67%. 67% of their revenue is spent on sales today. Okay? So these are still businesses that require huge amounts of cash. So the dilemma, if you're an angel investor, or even if you're an entrepreneur, is that you can get the first $150,000, okay? And that's doable. And if you hit a unicorn, more power to you, because you got your lottery ticket, and you should just go home. But you need a strategy to source the rest. On average, people say that it takes $25 million to get to cash flow positive. And so the basic advice is you want great teams, go after product market fit, and find a path to a financial center. So that's why I'm starting the Alchemist Accelerator, and I want to bring an Estonian company over, or any Nordic company. But if you find a path into the deeper pockets, it's critical. Okay, advice for entrepreneurs. And I'm going to go quickly because I'm almost out of time. Okay, get your funding from an individual that you trust and a fund whose size mirrors the exit that you want to aim for realistically. So be really honest with yourself about that. You cannot divorce your VC. You can divorce your co-founder, although it's awful. You can fire an employee. You can't get rid of your board member. They're legally in there. And know that when a venture capitalist makes an investment, he's trying to return back a third of their fund with every single investment. So if I have a $600 million fund, I need your investment to return $200 million, which means that if I own a third of the company, you have to exit for $600 million. So the rough heuristic is that your exit should mirror the size of the fund. And ask for references from other CEOs that have taken money from that VC before you do. Okay, the other big thing is that the bigger your vision, the more money you'll get. Okay, your evaluation when you first start fundraising is not a function of anything intrinsic about the business. It's just a function of how much cash you need to take you 18 months out and the ownership percentage that the VC needs. So if you need $1 million and the VC needs to own 20%, it's just 1 million divided by 20% and you're a $5 million company, okay? But the VCs are pretty cash insensitive. They just need to have the vision be big enough to pay back their fund. So they're happy to give you $2 million for 20% or $3 million for 20%. And you'll get that money if you can convince them of the vision of what you're doing. So go after a big vision and you'll get more resources if that's what you want to do. And then the trick is, for your next round of funding, you will be evaluated off of your results. So you need to figure out how much cash you need to get to a multiple step up for the second round of funding where the results can justify that step up. And you typically get 18 months to get there, and that's the art of fundraising. Okay, some final thoughts, and we'll try to get to the issues around culture and angels in different places. Well, the big thing actually on the angels in different places is that, you know, venture markets develop backwards, okay? So typically what happens is you get a public market first, then you have private sector mezzanine markets, and then you work your way back to angels. And so in Silicon Valley, it was built around entrepreneurs that succeeded. And so the angels have viscerally made money through public market, through startups that they've started. And here, it's more risk averse, my impression. But there's also a ton more opportunity here. There's so much capital in Silicon Valley that it's so hard to be a good investor, whereas here, there's so much fantastic talent, and Moore's Law does not discriminate. You can get technologies everywhere. So that's, at a very high level, some quick differences. I want to send you some final thoughts, which is that the future is going to be far more surprising than what you realize, okay? And this is because of that classic Moore's Law effect. So it's even the kicker in all of this is that, you know how I was showing you that everything was growing exponentially and that there's a multiple every year, so it's 2x every 18 months or 2x every 15 months? That multiple is growing exponentially, okay? So there is perpetual future shock that's going to happen over the next 10 years. And really, the next century is going to be 20,000 years of progress in 2012 terms, if that makes sense. So if you can imagine, if you take this out, those levers that we had before of open source software and Facebook for customer acquisitions and Amazon hosting is just the bare surface. We're going to be able to do so much more with such little capital every subsequent year. So if you take this out to its limit, you get some baffling brain exercises. The one is that by 2023, you could conceivably have the computing power of a human brain for $1,000. By 2037, you can have that for 1 cent. By 2049, you can have the human computing power of the human race for $1,000. By 2059, you have the human race for 1 cent. That's if you believe that this trend that has emerged over the last 100 years continues, and it hasn't stopped, okay? So it takes that type of belief to understand the opportunity that's coming forward. And so then the question is, what do you do with this as an investor? And what do you do with this as an entrepreneur? And the final takeaway that I want to leave you guys with is some analysis that Geoffrey Moore did. This is Geoffrey Moore's analysis, where he looked at the performance over the last 10 years of publicly traded companies. And I won't go through it, but you can see that a lot of these companies with fantastic execution teams, fantastic leaders, some of them, if they were good, they sort of got 50% better than the NASDAQ, but a lot of them did worse than the NASDAQ or hit it, okay? And these were the best teams. But there were two, these are the companies that had 150% variability with the NASDAQ. These are 300%, some are in the wrong direction. This is 400%, which is phenomenal. But there were two that had 1,000% variability with the NASDAQ in the right direction, which just killed it, okay? And that was Amazon and Apple. And if you try to think about why did Amazon and Apple succeed, and all these others who had the best brains not, Geoffrey Moore's conclusion, which I think is very right, is that it's because these companies were ruled by their founders, okay? And the founders are the heroes. And those are the guys that even when you have 10 years from now, when technology changes, they are the guys that are built to understand how to take advantage of technology curves. And your goal as an angel investor or any investor is to find the wild things, to find those crazy founders that will stick with it and continue to innovate. And that's where you get the biggest bang for your buck, is by having founders ride the wave all the way through public and then far, far, far after. And so I'm out of time, so I'll end it there, but I can also spend more time on addressing the questions in further detail. So thank you. That's my time.
Thank you, Ravi. Thank you very much.
Thank you.
This was an amazing speech. So basically you explained now, for me at least, why are the accelerators there? Because they just help to scale the VC business. That's it.
That's right.
Thank you very much.
Thank you.
But I think we'll have time for a couple of questions. Hey, here's your present.
Oh, thank you.
Yeah, a little thing.
That's great.
But we'll have time for a couple of questions, and I believe that there are questions there. At the same time, I will take the mics and put on to the next panel.
Okay, great.
Cool.
So if there's any, so do you want me to quickly address those questions that came up earlier? The quick thoughts that I have on the difference between angels in the Bay Area and angels here. Honestly, the biggest difference is the angels in the Bay Area have an ecosystem of follow-on funders, which makes it a lot easier to be an investor up in Silicon Valley. The difficulty and the asset that you guys have is that they all have to compete now, and valuations are getting so frothy that it's so hard as an angel investor to make money, I think. Whereas you, because there's less supply of capital here, it's a real opportunity. And the cultural differences, you know, I was not born and raised in Estonia, and I don't think anybody, and the weird thing is that even if I was, I would have been at a different time. Even if you were born and raised in Estonia, if you were born and raised during the Eastern Bloc era, it was very different than it is today. And so you can never really answer those questions correctly, because if even if I lived in both places, they would have both been different at both different times. But what I would say is that the thing that's interesting about Silicon Valley is that there's very few things that are correlated with success as an entrepreneur. It's like basically 2 or 3 things that you can objectively look at and predict success. But one of them is if your parents were immigrants. So having immigrant parents is a big indicator of entrepreneurial, one of the indicators of positive entrepreneurial success in the Valley. And I can't, you know, that spirit of that hard work ethic and entrepreneurship is born in places like Estonia. And so I think the raw material in terms of the entrepreneurs are here. It's just a question of getting that ecosystem and also having the cultural approval to take risks and to fail. And then finally on Stanford, you know, Stanford's so fantastic because of the resources that are outside of the university. And we can pull upon so many resources so that it's like a real-time laboratory. But I am so impressed, I have to say, with everything I've seen in Estonia. And I am so impressed with the level of sophistication of education and the earnestness that's here, that really there isn't that much of a material difference between what you can get here and what you can get there. The only difference is that what you guys see on videos, we can see live. And we can get access to those guys in real time, because when you're an entrepreneur, it can be a very lonely job. And it's nice to have a mentor that you can turn to. But the differences, I think, are going down.